Welcome to vTalkInsight, Market Drivers Daily for May 7th, 2026. AI-fueled equities are pushing toward record highs, just as geopolitical risk and energy shocks test how durable that risk appetite really is. Let's start with the AI engine that is increasingly driving both growth and asset prices. AI-linked investment has effectively become the main growth engine in an otherwise slowing global economy. Spending on equipment and intellectual property tied to artificial intelligence is doing the heavy lifting for GDP, while many traditional sectors are losing momentum. In equities, that same AI impulse is keeping major indices near all-time highs, even as breadth stays unusually narrow. The rally is increasingly dominated by AI infrastructure and a small group of large tech names. A significant share of recent global equity returns comes from semiconductors, hyperscalers, and other AI infrastructure plays, with only a minority of S&P 500 constituents outperforming the index. Internationally, Japanese tech, including high-profile holdings like major chip investors and broader Asian equities, are also benefiting from the same AI narrative, underlining how global this theme has become. Under the surface, an enormous capex cycle is underway. Hyperscalers are committing multi-year, trillion-scale investment plans, while AI data center bonds are emerging as a major source of new investment-grade issuance, and specialist operators are locking in multi-billion-dollar lease pipelines in places like the U.S. Gulf Coast. AI labs report exponential growth, with some posting revenue that has multiplied many times in a single year and signing landmark compute deals that secure hundreds of thousands of high-end processors and hundreds of megawatts of power capacity. This build-out is already pushing up prices for information processing equipment, adding to inflation even as official productivity data show little AI benefit so far. Looking ahead, the AI story is not just about capex, but about how the economy functions. There's a growing view that AI could eventually trim trend inflation by several tenths of a percentage point as productivity improves, and that it may decouple GDP from traditional job growth by automating more of the work that used to require large headcounts. At the same time, AI adoption is expected to widen income inequality and shift value towards sectors like semiconductors, defense, industrial automation, utilities, and even international markets that have lagged U.S. megacaps. The theme is also moving beyond core tech into applied AI in services, healthcare, and niche industries, with some case studies showing dramatic revenue acceleration when workflows are rebuilt around AI agents. The counterpoint is that this enthusiasm embeds significant risk. Large portions of tech market value now rest on aggressive AI revenue assumptions, and there is open skepticism that some leading labs will hit the cash flow targets implied by today's backlogs. Debt markets are deeply involved, with projections for over $1 trillion of AI-related data center financing over coming years, even as the profitability of many of these assets remains opaque. Credit risk is rising for legacy software and highly leveraged private equity-owned tech, and private credit markets are heavily exposed to low-rated borrowers that could struggle to adapt, with portfolio resilience potentially threatened if AI-linked exposure is concentrated across equities, credit, and private assets. The key watch points are evidence of real monetization and earnings, the breadth of the rally beyond a narrow group of names, and how spreads evolve on AI-related debt issuance. From there, the main challenge is how this AI optimism interacts with an increasingly complex geopolitical backdrop. Geopolitics remains the key macro swing factor, but markets are increasingly trading as if the worst outcomes will be avoided. Global equities are near record levels, helped by hopes for EU.S, Iran understanding, and optimism ahead of a high-profile Trump-Xi summit, while the dollar has retraced much of its earlier safe haven spike and oil has pulled back from recent peaks. That marks an evolution from a mix of de-escalation hopes and persistent risk premia we saw earlier this week. Yet the underlying fault lines have not gone away. The core tension sits around Iran and the Strait of Hormuz. Washington has floated a concise proposal, passed via intermediaries, that calls for an immediate end to hostilities and a phased reopening of key Gulf shipping lanes over about a month. In parallel, Iran is pushing for substantial sanctions relief and new shipping protocols while resisting meaningful nuclear concessions and maintaining an enriched uranium program. Tehran has also created a new authority to oversee the Persian Gulf Straits, requiring vessel registration. Yet shipping remains largely frozen as a naval blockade. Mines and security risks leave only narrow, escorted corridors open. One widely cited estimate suggests that, during the negotiation window alone, hundreds of millions of barrels of oil could remain effectively stranded. Energy markets and rates are reacting sharply to every headline. Brent crude has swung from well above $100 to below that level as talk of a deal gained traction, and crude futures curves now embed expectations of further declines, even as physical supply remains tight. Bond markets are juggling the disinflationary potential of lower oil against signs of persistent inflation pressure from earlier shocks and fiscal concerns. Central banks are becoming more vocal about energy-driven inflation risks, suggesting policy rates could stay high and that bond returns may lean heavily on carry rather than capital gains. At the same time, central bank gold buying has been strong, and there is growing discussion of a structural downtrend in the dollar linked to geopolitical shifts, even as it still behaves as a crisis hedge on days when Middle East risk flares. Beyond Iran, other geopolitical fronts are adding complexity. The upcoming Trump-Xi meeting is seen as a major event risk, overshadowing even key economic data, with markets expecting stability unless tensions spike. In the run-up, Chinese regulators have ordered domestic banks to halt new lending to U.S.-sanctioned refiners linked to Iranian oil, while also deploying legal tools to shield local firms from some foreign sanctions, leaving global banks and corporates facing higher compliance and policy uncertainty. Meanwhile, the U.S. has steadily expanded its blacklist of Chinese companies with military ties, even as both sides try to preserve hundreds of billions of dollars in annual trade. In Europe, defense spending is set to rise as NATO allies prepare commitments and countries like Germany push for new missile deployments and reaffirm support for Ukraine, all against a backdrop of political fragmentation that clouds the region's ability to project unified economic power. Set against this, there are genuine de-escalation efforts. The U.S., European allies, and China are all engaging Iran diplomatically, and a multinational naval presence in the Red Sea and Gulf aims to secure trade routes. Markets appear to assume that the Strait of Hormuz will eventually reopen and that any deal will lower risk premia, yet negotiations remain fragile. Iranian leaders continue to reject core nuclear concessions. Washington is intensifying economic pressure and maintaining a naval blockade, and domestic political pressure from high fuel prices make policy choices more sensitive. Corporate earnings warnings from companies exposed to Middle East disruptions, in sectors from appliances to digital advertising, underline how quickly real economy damage can surface. The key watchpoints now are Iran's near-term response to U.S. proposals, any concrete timeline for reopening Hormuz, outcomes from the Trump-Xi summit on sanctions and trade, and whether risk assets continue to shrug off repeated geopolitical shocks. Those same tensions are also at the heart of today's energy and supply chain picture. Behind the day-to-day swings in oil prices, the underlying energy system remains tight. Disruptions around the Strait of Hormuz, ongoing naval risks in the Red Sea and Eastern Mediterranean, and political rifts within producer groups are constraining effective supply and complicating logistics. Even though crude has recently pulled back and oil prices have stabilized after a volatile stretch, expectations still point to several more months of elevated energy costs working their way through the economy. Current price levels partly reflect the cushion from inventories built up over the past year, including significant stockpiles in Asia. Those buffers are now being drawn down, and physical barrels have recently repriced lower to converge with futures, suggesting that, for the moment, supply is meeting demand. However, if inventory draws persist into the third quarter, some projections put the risk zone for Brent crude in the $150 to $180 range, with refined products potentially moving even higher. One estimate indicates that as much as 500 million barrels of oil could remain off the market over the 30-day negotiation window for a Hormuz deal, and even a quick agreement would not normalize flows immediately, given stranded vessels, mined routes, and the need to clear backlogs. Shipping is where these energy shocks translate most directly into costs. Major container lines expect quarterly cost increases on the order of the low billions of dollars, largely from higher fuel and insurance tied to Middle East risks, yet they remain confident about passing much of that through via higher freight rates. Some Asian freight indices are already up around 40%, and rate dynamics now move more with energy prices than with the latest disruption headline. While overall dry bulk trade remains robust, and only a small share of volumes are directly caught by choke points like Hormuz, the rerouting of vessels, reduced effective fleet capacity, and tighter security protocols are supporting elevated rates that feed into broader supply chains. At the same time, concerns about jet fuel shortages in Europe and disruptions to transportation fuel in the Eastern Mediterranean highlight how logistic stress can spill into travel and regional growth. Corporate earnings and household budgets are feeling the strain. Energy majors have reported strong first-quarter profits, helped by higher prices and trading volatility, with one large integrated producer posting earnings well above expectations and launching multi-billion-dollar buybacks. Yet that same company has around 10% of its production offline due to vessels trapped by naval blockades and warns that output will be lower in the next quarter, a reminder that higher prices do not fully offset physical constraints. Elsewhere, shipping groups are maintaining guidance thanks to higher rates, even as they caution that conflict-related uncertainty could hit demand later in the year. On the consumer side, rising fuel costs are disproportionately squeezing lower-income households, while wealthier consumers have largely maintained spending. Restaurants and other small businesses are raising prices to cope with higher input and energy costs, and some manufacturers have invoked recession-like conditions in their guidance, cutting dividends and hiking prices. From macro and markets, the energy story feeds directly into inflation and policy. Higher oil and food prices are contributing to upward pressure on headline inflation, supporting the case for central banks to keep rates elevated and leaving bond markets focused on carry rather than capital gains through at least next year. Europe looks particularly exposed, with energy shocks layered on top of tighter monetary policy and supply chain disruptions, making underperformance over the coming months a clear risk scenario. At the same time, global oil intensity is lower than in past cycles. Fiscal measures have softened some of the blow, and commodity indices are already technically stretched after strong gains, all of which may be limiting the immediate growth hit. Policy options, including potential adjustments to strategic reserves and targeted support, add another layer to the outlook. Key markers to watch are the pace of inventory draws, the evolution of freight and container rates, corporate guidance from shippers and energy producers, and how central banks react to any renewed spike in energy-driven inflation. Taken together with AI's capex boom and unresolved geopolitical risks, this leaves a complex backdrop for multi-asset positioning over the next few quarters. To wrap up, AI remains the dominant growth and equity story, powered by massive infrastructure, spending, and early signs of real business impact, but it brings valuation, credit, and concentration risks that span public and private markets. Geopolitical tensions, especially around Iran, the Strait of Hormuz, and U.S.-China relations, continue to inject binary risk into oil, rates, and the dollar, even as headline markets trade as if a benign outcome is more likely. Meanwhile, the energy and freight complex stays tight despite softer crude, keeping inflation risks elevated, particularly for Europe, and reinforcing a higher for longer rate backdrop where bond returns lean on carry. Watch for concrete news on any Hormuz agreement, outcomes from the Trump-Xi summit, AI earnings and monetization signals, and hard data on inventories and freight costs to gauge how these themes evolve. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.